Another VC Wisdom Pod with Raj Sheth today. He is co-founder and general partner at Inuka Capital, Forex founder with 2 exits. So the guy's done it, unlike many VCs out there, not calling anyone out. But yeah, the guy seems to be quite into it. We had a nice little pre-convo here. Good energy fit between me and Raj. Can you introduce yourself real quick? Tell us a bit more about Inuka, Raj.
Thanks, Charles. Thanks for having me. So I'm originally from India, just moved back here after spending 10 years in the US. Inuka Capital is a pre-seed and seed VC fund focused on companies being built out of India. And me and my partner, Gautam, strongly felt, we both have been founders for the last 15, 20 years. And we strongly felt that at the early 0 to 1 stage, at the pre-seed stage, there isn't any dearth of capital today in India, but a lot of founders need tactical help to de-risk the 0 to 1 stage. And traditionally in India, the smaller rounds were being done by Series A VCs and a lot of other angel syndicates and other angels, but the founders have always been sort of duct taping the help they need in the 0 to 1 stage. And so we are hoping to institutionalize that early stage by doing Inuka Capital, and we're only going to focus on 35 investments over the next 3.5, 4 years.
Love it. Let's start with your exits. So you ran four startups. The exits, I guess, were more successful than the others. Tell us about these 4 startups and these 2 exits.
Absolutely. So in sort of my very early younger days, I was also in the US, in Boston. In 2006, I moved back to India. I was excited about the internet like everybody else. And I worked on 2 B2C consumer marketplaces focused on India between 2006 and 2011. Long 5 painful years. Both those companies completely failed. We can happy to double click into that. And the third company was a B2B SaaS product called Recruiterbox, which was a recruiting workflow software for small and medium companies. We were a completely self-serve product discovered on Google organic searches and other places. So we were able to bootstrap to the first $1 million, $2 million in revenue. In fact, we remained bootstrapped throughout the life of that company. And 80% of our customers ended up coming from the US. So started that company in India in 2011, but 2014 sort of moved base to the US. We still had our product engineering in India, but we had go-to-market focus in the US, and we were learning how to basically sell to larger companies and so on and so forth. And in early 2018, we were acquired by a private equity fund in the US. And at that point, we had 3,000 companies using our software, and we were a team of 65. So that was the third company. And the fourth company was another fun chapter. I guess the efficient bootstrap SaaS thing had rubbed off on me for 7 years. So ended up acquiring company in San Francisco called Fly Data that was flatlining. They had raised a lot of VC capital, $10-12 million. But 3 or 4 years later, I guess the team wanted to get out, and some things, and this happens a lot, right? Like great product, but things are not gone according to original plan. And I bought that business because what I loved about it is the product was great, but I loved the fact that it had very low churn, which I had faced a lot of in Recruiterbox, even though we had kept growing. But when you have smaller companies paying you smaller money, they keep leaving you. And this product, Flydate, had very low churn. So anyway, I bought that company. We basically brought it to 50% profitability, rehired my Recruiterbox engineering team out of those funds. And we turned the company around, so to speak. And we were going to keep going, but exactly a year in, a direct competitor offered us, 3.5x of what we had paid for it a year ago. So, took that exit. That was at the peak of 2021. In hindsight, the overwhelming advice that I got from a lot of people is, take that because you may end up in the same space a few years down the line. So did that, moved back to India, and I already told you the story of Inuka. So that's a little bit of the timeline.
Wow. Okay. So how did the exit feel? How did it change your life?
Yeah. So it's funny. The first exit, to be super candid with you, instead of, it was great, right? No regrets. But the first exit, I would have done things very differently now. So to answer your question, how did it feel? At the time, it felt great. It felt like a goal was achieved. It felt like relief. Uh, I had been running around for 15 years before that. So I took like a year off, and, you and I were talking about traveling. That was my biggest traveling year after that exit. And for the first time, I felt like, I literally felt like till that point in my life, I didn't have an off switch, or I didn't know what it was to sort of sit back and think about things. And, classic Maslow's hierarchy of needs. That was the first time I was like seeing any serious money in my bank account. But the lesson in hindsight is that I think if I had been a little more patient, if we had been a little more patient, we would have learned more and probably got to the next level. And that learning would probably be more crucial, because it's so hard to start something again from 0 to 1. And the point is, if you keep doing the same thing, then that's great. It's a great way to make a living, but then you're not learning about the next stage. So that's a little bit of a loaded answer on how I felt. The second exit actually felt much better. That felt like a much smarter use of 12 to 14 months. The first time around, we spent 7 years on it. And I could have done 3 or 4 more. I just need to rewire my mind.
Right. And I guess you decided to take that money and start your VC fund. What's the mental model behind that? Because a bunch of people would just invest these in Vanguard index funds and sit back and relax and chill. Some crazy mans would reinvest it in a moonshot company, like that would probably be me. And others would take the VC road and be like, okay, yeah, I'm sitting on a couple millions now. I'm gonna cut micro checks to pre-seed startups and probably have a 10x return in 10 years. I guess that was your mentality, or somewhat near that. So what was your mental model behind the VC fund?
Yeah, no, great question. I'll tell you my mental model allows me to clarify how we're going about it and thinking it. So it's funny, it's a little bit of all the three things you said, interestingly. So I don't have all my money in the VC fund, right? To be very honest, because it's uh, the fund, the fund has LPs and other investors. We have obviously put an amount in it, which is pretty standard to what what they call GPs, general partners, would put into it. But just like you, just like a lot of people, I do also have my money in, public equities, etc. In fact, all funds, all family offices, and all individuals probably put 10% of their net worth in private equities, and they're more weighted towards public equities. And that's more a personal finance allocation thing. So I do have my money in what you said, ETFs and all of that. I do have some money in the VC fund. But the motivation behind doing the VC fund was a little different. I sort of felt, after sprinting over these 4 companies, etc., I was trying to do the next one, the fifth one, and I think I needed a huge reset in life. And I didn't think I had one more company in me and hiring 100 people and working with 100 people. But I still love the 0 to 1. I still do love the 0 to 1, and I wanted to keep learning. And also, I had done certain types of businesses, but I'd explored some other ones, especially consumer. And with my co-founder here, this allows me to learn a lot. It allows me to help founders de-risk on the 0 to 1 in the best way that we can. And some folks are doing companies which they are phenomenal to be a part of, but those are not companies that we would be able to start, but those are missions we care about deeply. There is one company, for example, our first investment, that's bringing accessible last mile blood tests to 80% of India that don't have those blood tests. I can explain how that actually works. They have a hardware and software model. But my point being, those guys have spent 20 years in this domain. Then they decided to do a company. we are super excited about it. It's phenomenal, but that's not a company that I could start. So I think I'm going to enjoy sort of almost living vicariously through these 35 bets we make.
Interesting. Thank you for sharing that. I want to talk about the startup ecosystem in India. What are you seeing? What macro trends and potentially micro trends are you seeing in India that could make your investment way more profitable than if you'd invest in other countries?
Absolutely. So I'll break this answer in exactly 3 parts. So it's also, if the audience remembers one thing about India investing, I'll talk about these 3 parts. The first part is there were a lot of very successful models in India which were replicas of what was happening in the US, right? There is a US Uber, there was an Uber for India, whatever the Indian companies. There was, US DoorDash, there was an Indian DoorDash, so on and so forth. Many of these companies have done phenomenally well. And this was like the first phase, like as internet was coming in, and that was great. Then what started happening is internet usage in India. I don't know if you heard of Geo, for example, but in 2015, 2016, 800 million Indians got access to really fast internet and really affordable smartphones. And that led to 3 phases of internet usage. The first phase is people started consuming content. So there was a lot of, like, of course, social media, news, communications, social apps. There was content consumption. The second hierarchy of usage was people started buying goods online, e-commerce, right? So there was transactions. And the third hierarchy of usage is people started transacting financial instruments and financial products. So they started buying equities or insurance and so on and so forth. What's interesting is the second and third happened really quickly. Honestly, I personally, and we were surprised how quickly it happened, and also in a lot of regional languages. So based on this, whatever internet usage we've seen between 2016 and 2021, we have a strong feeling on the fallout effects this is going to have on small businesses in India adopting that technology. We're talking about individual consumer internet here, but we feel that traditionally the big VC or the big SaaS software criticism for India has been that, hey, it's a low value market and businesses don't pay. That is true. But what we are seeing in the next 10 years is there are going to be super interesting business models as small business adopts technology. So if number one, there was obviously consumer internet things, that work in the US were working here. D2C was really big. Number two is we're going to see interesting fallouts of businesses that are uniquely Indian, because the Indian businesses and the Indian consumer mindset and the Indian business model, they may not pay a subscription, but they may pay transaction of revenue, for example, is going to have interesting fallouts. And finally, the third one, I want to talk about the founders. So because of the last 15, 20 years of exposure that a lot of, talent, let's call them talent before they became founders, the exposure they had of working at scaled startups, of working at various different startups, remotely working for Valley startups out of India, that created a whole generation of these cross-pollinated founders. So in simple words, what I mean is a founder that I talk to today feels 100 times smarter than what I was 15 years ago or 12 years ago. And whether they're coming out of engineering college, or whether they were basically in the leadership team of the last startup or company that saw serious scale, these people have seen a cycle, and they have basically they have been upskilled to the level where they were working with the best engineering teams in the world. We're seeing interesting fallouts of that. So if you put like these 3 things together, we're sort of super excited about what can come out of India in the next 10 years. And we're super bullish that it's going to be unprecedented to what it was before. Not to mention the public equities market in the US. So some of these companies we expect will go IPO and will go public on the Indian Stock Exchange. which is sort of becoming more and more robust in terms of regulation, in terms of governance, and also in terms of valuations.
You know what I like about these emerging markets is the moat that founders have of having a foot on the ground and really understand the market. Now, yeah, sure, they're building online businesses. Other bigger players could get into that. Let's say that, I don't know, Google would hire a team to build a startup in India to do the same thing. But yeah, not really the same, like I think founders that have a foot on the ground there are really gritty and have that fight in them, and they know the landscape, right? So when you're talking about Ward, you need to know your landscape and what strategies to use, how, and yeah, if you know the customers, if you know the culture, that's certainly a moat. I've been talking to various founders from all over the world, and I've been talking to this founder in Nigeria. So imagine in Lagos, it's, most of us cannot imagine what it is to step foot on the ground there, how things are different, how the cultural shock and so forth. And that's the moat that they have. So I'm also very excited about India. I want to ask though, you've invested in a bunch of startups nowadays. I want to talk about a few of them. One of the most exciting one is acquire.com with Andrew. And yeah, this one caught my attention for sure. Tell us a bit more about the platform, because it's kind of investing in an investment platform, which is funny. What was your take on that one? Was what your thesis before you invested?
Yeah, absolutely. So very quickly, just to clarify this for the audience, I made 2022 personal angel investments before this VC fund, which was an India-focused VC fund. What you're referring to is the early angel investment that I started doing, obviously, with my own capital after that first exit. What had happened is, if you remember my story, I said the fourth startup that I did, I said I acquired that company, right? So during the time when I acquired that company is when I spoke to Andrew, and I'd sort of, through the grapevine, through LinkedIn and through email, we had sort of exchanged a note, and he heard what I was doing. So at that time we had quickly talked, and he said, I'm doing this thing called microacquire.com. And this was super early, right? Like I spoke to him late 2020, early 21, microacquire. He was just launching microacquire, I believe. And essentially your question was, what do they do? What's awesome is, so you've obviously as more and more SaaS companies and software companies and smaller SaaS companies, like if we go back 15, 20 years, of course there were like very large companies. If you remember in the late 90s or early 2000s, people used to raise $1 million just because the server was so expensive. And the point being that you come to in the post 2010 era, because we had AWS, so many people, like two folks with two laptops and $20 of hosting is starting these SaaS products. Rest is history. Everybody knows there are lots of tools. Now, because there are so many companies, that don't do the traditional venture route, and they could be doing from 200, 500K in annual revenue to 50, 60 million in annual revenue. And there are so many of those companies. Andrew correctly identified that there has to be a structured space, not just this fragmented broker ecosystem, but the structured space where people can transparently come and buy and sell these companies. And till now, the long tail of it has been smaller companies, and we'll see where that goes. But the point is, having one structured place where people can buy and sell companies seemed mind-blowing. And if you've seen Andrew's execution of him being able to build this a platform, I hope he won't mind me saying this, but in my mind, I keep thinking is what AngelList did for angel investing, acquire.com is going to do for acquisitions, which is huge, right? And so I was fortunate enough to be able to, he was raising a round at the time, and I was fortunate enough to invest in his company. So and since then it's gone great guns. So I'm hoping it'll be one of my good wins.
Right. How can you invest in the next Instacart. I believe Instacart's from India, right?
Yeah. Well, Instamart is one product in India, and
What
Instacart,
was
I believe,
the
is the
Amazon
Valley.
of India again? I forgot their
Oh,
name.
that's Flipkart. That's Flipkart.
That's the right one.
Flipkart.
Pardon my brain here. So how
No,
can you
no.
invest in the next what's it called again?
Flipkart. Flipkart. Yeah.
Flipkart? Yeah.
Yeah.
Why is my brain like so unfamiliar with that? Maybe because I've never used them. How can you invest in the next Flipkart?
Yeah, the honest answer is it's super hard and I don't know. But I'll tell you how we make decisions and hoping to be part of the next Flipkart. And especially because we come at the pre-seed stage, right? Which means we are the first check-in, which means there is so little data. Like there's no product market fit, there might be a few pilot customers, etc. So how do we make decisions? We have basically come up with a bar, like a line, a bar, and we try to play above the bar. So what is this bar? What do I mean by that? We basically have uh, things in terms of the founding team and the founders, right? We are very biased towards, and we love founders that have a deep connection to that space. They could be first-time founders, it could be a new company, but they have a deep connection to the problem that they are solving. Maybe they've had the problem for many years, or in the blood test company case, those people come from the field, right? So we bias towards that. The second is, and this will be a little subjective, so I'll give an example, but we really bias towards founders that have strong product DNA, right? Like, because our whole thesis of our fund is companies that can use product for unfair distribution advantage. Like, of course, they'll have sales too, but we love teams where they can build product which is not a common skill set. Your product is a very opaque, sometimes very not easily people can't define it very objectively. But we've seen teams that have created phenomenal products. If you think about Figma, if you think about Notion, the jury's out on Notion for some people, and even acquire.com. If you use the browser Arc, A-R-C, some teams can just build phenomenal product, right? So domain, connection to the domain, strong product DNA, being able to attract early talent. The first 5-6 people that we see have to be pretty solid and well-rounded and complement each other. That's a little bit about the team. And then we come to the space, and we are biased towards certain spaces. Like, so if I said, hey, what's technology going to do to the long tail of small businesses in India? So we bias towards that, versus we don't do any D2C physical products. We don't do fintech, because everybody is doing some sort of a lending fintech company in India, so we won't do that. So we try to index very heavily into what spaces we like and what founding teams we like, and what's a world that we are seeing, and why this thing being done now is going to be super impactful versus it being done 5 years ago or 5 years from now. So we kind of, the why now question. So we put those things together and hope we're investing in the next Flipkart. But the truth is, one never knows, because at the pre-seed level, as I'm sure you very well know, that so many variables kick in over the next 3 years, and usually you would only know after 3 years or so as to how the company is tracking.
I guess it's the VC's dream to have control over that, like pop up a generative AI, chat GPT for VC, and that can constantly coach the founders on giving them the right advice and probabilistically giving them the right advice for that situation. Because in the end, it's about good decision making, right? And I mean, if you take 51% of the time good decisions, most of the time that's not good enough to make you a unicorn. I think the best startups take great decisions probably like 90% of the time, which is in the top percentile. Let's say that I take good decisions 80% of the time, so I wouldn't even qualify myself as a unicorn anyway. Food for thought right there. Raj, thank you for showing up today. Where can people find out more about you?
I'm on LinkedIn, Raj Sheth. I'm sure we'll share as part of this blurb. And email is really easy, raj@inuka, INUKA .vc.
Thank you so much.